Hey everyone, welcome to part 3 of the Janison series. You can watch part 1 and 2 over there, where we talked about the history of the company, who they are, what they do, what they're going to do next. And then the valuation, where we looked at our assumptions on what we believe the company should be worth, what they can potentially hit, and how we go about valuing the business from the four metrics, revenue growth, operating margins, reinvestment, and risk. So now this video is all about if we're going to invest in this company or not. Remember, before we talked about the valuation of the company in the second part as we're giving it a fair value of $168 million, which corresponds to an 80 cents share price. So the share price right now is around about 40 cents. So should we be investing in this company? Well, let's have a look, right? Please keep in mind, this is general advice. This is not personal or financial advice. What I'm telling you right now is based on my assumptions, okay? So it's not your assumptions. Your assumptions can be completely different to my assumptions. And when you do your own valuation, you will find out that there's a lot of things that you disagree with. And that's what I want. I want you to disagree with what I've assumed. Because you can be very bullish or very bearish, but you must have a reason as to why you're bullish or bearish, right? So I've laid out my assumptions in the second part of my series, which is the valuation part, and it's all general information. It's not financial advice. Please don't use it as financial advice because the information we provide is general in nature, and it's just a metric to use when we think about valuation. So when we're looking at this company, what we're really doing is we're seeing the risks. Right? So we're looking at the risks. So we use risk before in the form of cost of capital when we're doing the valuation. But we should also think of risk in terms of investment risk. So how much we're willing to lose, can the thesis change, right? Because the future is uncertain and we don't know what is going to happen in the future. But in saying that, if we believe certain things were to hit, this is how much we should be willing to pay for it. So that's what we're looking at when we're looking at the evaluation, whether or not to put into a portfolio or not. So just a quick recap. So as you can tell, I assumed a revenue growth of 21% CAGR, which means $150 million in revenues in 2030. So that's going from 20 to $150 million. So that's an 8x growth that I'm assuming for this company. I'm also assuming that they're going to reinvest pretty well. So a sales to cap ratio of 1.5. So sales, incremental sales divided by the invested capital. Incremental sales is, let's say you made $10 million in revenues today, and next year you're going to make $20 million in revenues. So you're going to get $10 million more. But to get revenues, how much did you reinvest? So that's the invested capital. So $10 million, let's say you invested $10 million to get those revenues. That means 10 divided by 10 is 1. So your sales to invested capital ratio is 1. So meaning that you had to invest $10 million to get the $10 million in revenues, which is okay, but it means that it's slower at scaling, right? Because you much rather have a company that you invested $2 million, right, to get $10 million in sales, right? That means you only had to invest $2 million to get 10. So you're getting a sales to invested capital ratio of 5, which is insane, which means the company is very capital light and you can grow really, really fast. And that's what is really important when we're looking at technology businesses. And what I'm assuming is Janison in the first couple of years are going to struggle with the sales to cap because they're not going to grow at revenue that quickly. However, in the long period of time, I believe that they can catch up. And that's why I'm giving them a 1.5 sales to invested cap. Operating margins, 15%. I assume that you can check the previous video to look at the assumptions on why I made that. Perpetual growth rate of 2%. And my assumptions gave me a valuation of $168 million or an 80 cents share price target. So potential catalysts that can increase this valuation is increasing the number of OECD customers. Remember, OECD is a contract that Janison signed. It's a key contract for their growth. And if they manage to get more schools per country, they can really accelerate their revenue growth. So that's something that I did not include in my valuation. And there's also other things such as the channel partners, right? Because Janison also got national service providers who are channel partners for Janison that set the OECD test. But also those channel partners have their own businesses as well. They have their own tests. So if Janison was to cross-sell the Janison Insight platform to those tests, Janison can get more money. So that's another catalyst I didn't think of. And another catalyst I didn't think of is cross-selling the ICAS exam, which is that recent acquisition that they did with UNSW Global. If they can get more revenue per customer in that exam, again, that's another catalyst I wasn't thinking of. So there are catalysts for Janison that I'm not considering in my valuation. So it could potentially drive the valuation up or down. But catalyst means something good. Negative catalyst means if they manage to invest a lot of invested capital and not get that revenue growth. So what it comes down to is a valuation matrix, and this is what I came up with. So on the left-hand side, we can see the cost of capital, and on the right-hand side, we can see the revenue growth. You can clearly see how I got that 79-cent price target by assuming a 5.5% long-term initial cost of capital and a 20% revenue growth. But if I were to increase the revenue growth by another 5%, 25% CAGR or a 30% CAGR, that means I'm assuming that Janison is going to make $200 million, $300 million. And if we look at, if we put it into the matrix, we can see that Janison's valuation goes from 80 cents to $2. So it's insane. You're like, whoa, okay, that means current share price is 30 cents. It's completely undervalued. Hang on a second. I'm assuming that the revenue is going to grow that quickly. However, if you're pessimistic and you give only a 10% revenue growth, that means you believe Janison's going to get $56 million in revenues in the next 10 years. Meaning that the current share price, the current valuation that you get is 28 cents, which is less than the share price. So you believe that the current share price is more expensive. So this matrix tells you how much you should be willing to pay depending on where you fit. And that's what's really cool about a matrix. With this matrix, you can determine the current share price and what the market is thinking. Because at the moment, a lot of people talk about, oh, share price went up, share price went down. What does this mean though? If a share price, so the way I look at it now, is if I see the Janison share price to go up to $2, what the market is saying is that they're assuming that Janison's going to grow at a 30% CAGR, meaning in 10 years time, they're going to get $300 million in revenues. And right now they're sitting at $20 million. But the discount rate is going to be at 5.5%. So I'm assuming that the market is saying extraordinary things about the company, and I don't think that the company can hit those targets. So that's what you should be thinking when the share price goes up and down. And you want to buy the company when you believe that the market is very unhappy with it, but it's less than your valuation. So my valuation is 80 cents and the share price is 30 cents. So when you look at the annualized return, you can look at it. So if I were to buy Janison right now at 37 cents, the annual return I could get is 16% per annum, but the absolute return I could get is 114%. That's assuming that I buy the company at 37 cents and sell it at 80 cents. If I buy the company at 37 cents and it goes to $2, I'm assuming a 4x return, so a 400% return, and an annualized return of 40%, which is amazing, which is what you want to do. But you have to also assume that you're making a lot of concessions in doing that. So it's very important to highlight your assumptions, and it's important to revisit the valuation when Janison hits certain targets or miss certain targets. So that's why this channel is all about revising our assumptions in a period of time, so that we can revise and see if the company has changed their business or not. So, portfolio decision, what you've been waiting for. What are we going to do with it? Well, we're going to invest. I'm actually going to invest in this. I believe it is worth the investment for the long period of time, and we're going to put a 10% weighting on it. So, in other words, we start with $10,000, and we're going to invest $1,000 into Janison, okay? So as you can see in this pie chart, that's Janison right now. 90% is cash, so $9,000 we have left in cash, and assuming brokerage is about $10, we're going to get about 2,600 shares. So I'm pretty bullish in Janison, and I believe that my assumptions that I made to get that 80 cents fair valuation grossly underestimates what they could potentially do in the future. So that's why being very conservative, by being conservative and still getting a high valuation gives me confidence that if Janison was to outperform, they can outperform the valuation and can do well. But this, remember, is my assumption, and this is for the channel. Don't use it as for yourself to putting in your own financial needs. Please make sure you validate your own financial thesis and don't use this as financial advice for making investment decisions. Remember, this is what I believe the company is worth, and this is not what you believe the company is worth. So they're two different things, right? So it's very important that you talk to a financial advisor if you are using this as financial advice, because this is not financial advice. This is general advice, just letting you know. So in saying that, I talked about how we should track this portfolio, and we're going to be using Sharesight. So let's hop over to Sharesight and see what it's all about. Hey everyone, welcome back to Investing Ethos. This is an overview of what our portfolio would look like. So at this stage, we just did a great deep dive on Janison, and we decided to invest in the company. Bear in mind, I did this video way back, and I bought shares in Janison in October of last year, which represents 10% of our portfolio. So I bought $1,000, and now it is worth around $1,400. So we made a 42% return. And so what has happened is that in Sharesight, you can use this platform to track your portfolio. And I think it's a really great platform because you can clearly see what our portfolio would look like when we add more companies to the portfolio. So that is what this platform is all about. And this is just a great demo just to see, just to show you like what are some of the, added functionalities of Sharesight, and why I think it's a really great platform for you to use to track your own portfolio, because this is much better than a spreadsheet for you to monitor. So we decided to invest in Janison. So if we were to go to Janison, as I'm doing right here, and click on the company, it goes to the company page right here, which is the Janison page, and you can add in the details of the investment. So I bought in October 16 of 2020, 2,540 shares at a 39 cents share price, $10 brokerage, and I paid $1,000 for the portfolio for this channel. So what that would mean is for you to add in a new trade, or for Janison, for instance, you click on enter a new trade, and you fill in the details. So the way I did it was I put in 2,540, share price at the time was 39 cents, and then I add in the brokerage, which is usually about $10 if it's under 1,000, which it is at this stage. And then you press save trade, and you make sure you put it on the right date in which you made that investment. So for me, it was October 16th, and that's what I did. So what is really fantastic is you can see three different types of gains. The capital gain, which is basically the share price appreciation, really important. The dividend gain, which shows if the company were to pay out a dividend, how much of that is a return for you as a shareholder, which is really hard to track if you use Excel. And currency gain, this is really important, because this portfolio at this stage is for Australian companies, but when we end up adding in American companies for future videos and when we do future deep dives, you can add in the currency gain as well, because most Australian investors could convert into USD, and during that currency exchange transaction, if you bought the currency at a price and you sell it at a higher price, you get a currency gain added on top of your capital gains. But some of the time, obviously, you're going to lose out on the currency gain if your country currency were to depreciate against like USD, for instance. So it's really great what Sharesight has done, and split the returns into three buckets, and you can get your overall total return from it. And that's what I really like about this platform. It gives you a holistic view on what your total return would be when you're investing in whatever strategy you decide to choose. So if we go back to the overview page, what is really fantastic is you can basically use different types of analysis to determine how well you believe the portfolio did over a period of time. So you can show your return based on since first purchase, since this month. You can clearly see the returns looks much different, because if we were to look at Janison for this last month in February 2021, it didn't do that well. But if we look at it from the beginning, so since first purchase, there you go, you can see that we appreciated by 42%. So this is really fantastic, because when we add more portfolios, we can use Sharesight to give a holistic view on how much of our constituents in our portfolio generated what type of returns. So this is really fantastic, and I really recommend you using it. And what's even better is if you want to track your portfolio performance, the best way to do it is through a benchmark. You can use a benchmark to compare your return with a return from the industry indexes. So for instance, the ASX 200 or the S&P 500. But that is obviously for not the free plan, which is what we're in at the moment. That's mainly for like the starter or the investor plan. I recommend the investor plan. I use the investor plan in my personal portfolio for the channel, because it just has everything, and you're not really restricted to 10 stocks in your portfolio. In the investor plan, you have unlimited holdings, as well as 3 portfolios. So you might have a different portfolio for different type of strategy, which is what I have. I have an Australian portfolio, but I also have an international one. So it's really fantastic, the investor plan, because it's value for money. And when it comes to tax time, it just does the tax return for you. You just have to, connect your brokerage with Sharesight, and it just does everything for you. It saves you so much time, and you can really use Sharesight to analyze how you're going with your portfolio, to see where your returns are and how to maximize your returns. And I think it's a really fantastic platform for this. So you can clearly see you even have zero integration, because most accountants use Xero when they're doing tax time. So if you already have a zero integration option, it makes the accountants work much more easier, because all they need to do is just do a little API and you're good to go. So what's really fantastic about this platform as well is contribution analysis for the expert plan. But even in the investor plan, I got a bit of a taste on what contributions would look like for a trial, and it's fantastic. What it really shows you is if you have a very large portfolio with many stocks and many holdings, it shows you per sector how your holdings have performed and where your key laggards are in the portfolio, because not every company that you invest in will do well long term, and you usually have a diversified approach. You really want to see which companies are really hurting your overall performance and which companies are doing well. So that's why contributions analysis is very important. And now there's a reason why it's in the expert plan, because it is used for people with very large portfolios. So this plan is not really geared towards retail investors or even sophisticated investors. These plans are geared towards the institutional and SMSFs, so people with a lot of money. So at this stage, we're going to be sticking with the free plan, but I really recommend the investor plan for a personal portfolio. It's really fantastic. You get getting a discount as well for the yearly option, which is what I'm in. And you have a lot of added value on it. There's just a lot of integrations going on with the investor plan, and it makes your life much easier. So yeah, this is just a quick overview of Sharesight. There are different types of tabs to go through. So I have the holdings tab to add in a holding if I want to, or search for a holding. Reports tab, which is fantastic, which just shows you when it comes to tax time some things with your portfolio. So performance reports are what we can have for the free version. It just shows you the total return. When you have a return. So in this stage, we invested in Janison and we haven't sold yet. So if we were to sell Janison, I'll just show you right now. So we add in a new transaction, enter a new trade. So let's say today is the 11th of February and we have 2,540 shares, and at the current share price, let's say it's 56 cents.
brokerage would be about $10. And instead of a buy, we have a sell. So we are out of the position. Look what happens. The portfolio gets updated. You can clearly see that we've sold now. Capital gains is not shown here because the stock is no longer in the portfolio. But then if we go to the performance report, we can see our gains, show monetary gains for the current financial year. There we go. Show open and closed position. So in this case, it was closed. And you can see 42% capital gains, and this is what we'll be using when we're checking the performance if we do were to sell the stock and things like that. Yeah, so it's really fantastic platform for you to analyze your investments, and I really recommend it. So yeah, have a go at it. It's very interesting, this platform, and yeah, back to you.
So, hope you enjoyed that Sharesight demo. Really cool. You get to see how the platform is used, how it can use to track your investment returns. I really recommend it, and weirdly enough, I'm not like a person that likes to promote products and stuff, but I gotta admit, Sharesight is like the best. It's the best to track your returns. So definitely use that for tracking your portfolios. They can do both US, I think, as well as Australian. That's why, us Australians, I like it, but potentially they could expand to other markets like in Europe and stuff. But definitely use, we're going to be using this channel Sharesight to track our portfolio and to see how we're going to go. But yeah, thanks everyone. This is my first company added to the portfolio, which is Janison. A really interesting company, I believe, has potentially a very nice long-term growth, and not really looked at by investment professionals as much, and not really looked at by the market as well. So remember, some of the tech stocks right now with COVID impact, they've been growing up, they've been growing crazy. So there are some opportunities like Janison that just no one's looking at it, and it's in the education technology business. And when you do the valuation, when I did my valuation, made my own assumptions, I saw that this is completely undervalued in my eyes. But in your eyes, you can agree with the market and say it's right now fairly valued, or you can say that this is actually overvalued and it should be the growth should be going down. So that's my video, guys. Hope you enjoyed the Janison series. It was quite a lot of work for me to go through it. But I hope you guys learned something about valuation and thought about how you should think about a business and value the business. And moving forward, next company we're doing is a Whisper. So this is something that the market has valued. The market really likes, and a lot of people have invested shares in it, and a lot of people are very interested in it. Whisper is an Australian technology company, a communications platform, and it's going to be really interesting to see how we go about valuing it. So thanks so much for watching. Please like, subscribe, and comment on what you think we should do to improve, and hope you enjoy it, and stay safe, stay COVID safe. All right guys, thanks.